So using this reverse rollover strategy can allow you a complete exemption from required minimum distributions. Now, this certainly won't apply to every family, but can be used quite creatively. Many retirees are familiar with the 401k to IRA rollover. This will be the type of rollover the vast majority of retirees will use. A far less known strategy is one that essentially reverses this process. Rather than rolling your 401k into your IRA, you roll your IRA back into your 401k. This is called a reverse rollover. Now, why would anyone want to perform a reverse rollover? Well, because there are some strategic ways that you can use the IRS rules against them to gain earlier access to your retirement accounts, to perform a backdoor Roth conversion, as well as gain an exemption on required minimum distribution. And so here are 5 reasons that you may want to consider a reverse rollover for your retirement. When you save into your retirement accounts, whether you know it or not, you are agreeing to some liquidity constraints. Until you reach age 59 and a half, for the most part, the money inside of your traditional IRA cannot be accessed. If you access it prior to 59 and a half, you will incur a 10% early withdrawal penalty. But what happens if you want to retire earlier than 59 and a half? You may have the financial capability to do so, but all of your money is locked behind this artificial IRS wall. You are asset rich, but cash poor. The good news, though, is you have some options. Company plans like 401ks and 403bs have a unique loophole called the Rule of 55. Essentially how this works is if you retire from your company, in the year you turn 55 or thereafter, you gain free access to the funds within your 401k. And so essentially the Rule of 59 and a half turns into the Rule of 55. So for early retirees, this can offer an additional 4.5 years plus of access to your retirement accounts. Public service employees like police officers and firefighters can gain even earlier access. Their retirement plans allow for access as early as age 50. And so they can gain an almost 10-year liquidity advantage from age 59 and a half down to age 50. And so using a reverse rollover and taking your IRA and rolling that into your 401k, 403b, or thrift savings plan can give you earlier access to those funds because you can use the Rule of 55 or the Rule of 50 loophole. High income earners are at a disadvantage when it comes to shoveling money inside of tax-free accounts. For instance, if you earn too much, there is an income limit where you can't contribute to Roth IRAs. Now, there is a way where you can sidestep this rule with a strategy called a backdoor Roth IRA. Now, here's how this works. You make a non-deductible IRA contribution of $6,000. Now, there is no income limit to making this type of contribution because you receive no tax benefit. It's non-deductible, meaning that you already paid taxes on that given contribution and now you're contributing it to a traditional IRA. Now, the reason this is powerful is because you can immediately convert that non-deductible contribution without any tax consequences. Remember, you've already paid taxes on that given contribution. There is no income limit on a non-deductible contribution, and there's no income limit on a Roth conversion. And so we can make that contribution and then immediately convert it to a Roth IRA. And essentially what we did is we sidestepped those income limits for a Roth IRA. Be very careful using this strategy, however, because there is an IRS rule that's somewhat difficult to sidestep. It's called the pro rata rule. So let's say that you had $1 million traditional IRA and $100,000 of that was non-deductible IRA contributions. And so you perform a $100,000 conversion thinking there's going to be no tax consequence because you're converting that non-deductible portion. However, at the end of the year, you find that your taxable income is $90,000 higher, and you're quite surprised from this. The reason your taxable income is higher than you thought is because you didn't understand this pro rata rule. The IRS will only allow you to convert based on the ratio of non-deductible funds to your IRA value. And so in this example, we had a 10% ratio, which means for every dollar you converted, only 10 cents of that was tax-free because it was non-deductible contributions. Now, luckily, a reverse rollover can help you sidestep this pro rata rule. You can roll over your normal funds into your 401k and isolate that non-deductible portion. 401ks and 403bs are not included in the pro rata formula, so now you can convert that full non-deductible portion at no tax cost. Required minimum distributions are a forced withdrawal from your tax-deferred accounts. And so for those that have fairly large tax-deferred balances, this can represent a big tax liability for your retirement. You're forced to take money that you potentially don't need, and it's fully taxable that can push you into different tax hurdles in retirement. But there is an exemption to this RMD mandate called the still working exception. If you are still working, you are not forced to take your required minimum distribution from your company plan, thus giving you an exemption from RMDs regardless of how old you are. Now, I would never tell someone to go back to work or continue working to avoid a tax problem. That seems like we'd be focusing on the wrong things in life. But I have seen some use this quite creatively to gain an exemption from this tax problem. One retiree was able to negotiate a consulting arrangement with the company they were previously working for that allowed them to only work a few hours a week, but allowed them to avoid a six-figure required minimum distribution. Another retiree found a part-time job that they really enjoyed and brought them some fulfillment in retirement. They were able to perform a reverse rollover, rolling most of their IRA funds into their new 401k, allowing for this still working exception, and again, delaying RMDs so they could fill in with Roth conversion. Now, this RMD exemption isn't a solution for every family, but with some creativity, can be used quite effectively. Creditor protections have a different value for every retiree. Now, most retirees will never have to worry about needing that creditor protection. But if you're someone who views this as a risk to your retirement, know that 401ks have significantly more protections than individual retirement accounts do. 401ks, because of various laws, are protected at the federal level, where at best IRAs are only protected at the state level. And so performing a reverse rollover to move money from your IRA into the 401k and gaining that additional protection can be valuable for some retirees. In some specific cases, you may be lucky enough to have some custom options as part of your company plan. For instance, we were working with an individual that had a 4.5% fixed interest option as part of their company plan. This was a completely liquid option that was very unique to their situation. Early last year, when this retiree was looking at safe alternatives inside of this low interest rate environment, they were pretty unimpressed. CD rates were in the gutters, bond rates were abysmal, and carried a lot of risk that we're seeing playing out right now. So using this unique alternative available inside of their company plan that had above average fixed interest rates was an awesome solution for this retiree. We were able to roll IRA funds back inside of this 401k plan to take advantage of this. Now, there is one type of account that you almost always want to use and perform a standard rollover with, and that's a Roth 401k. You may not know this, but a Roth 401k has required minimum distributions. You will be forced to take money from these powerful accounts, thus draining value from these accounts. Now, luckily, there is a very simple solution to fix this problem, and you can learn that by clicking on this video right here. Always remember, you don't need more money, you need a better plan. Thanks for watching.